mean, I've gone to the test facility and I've seen people coming out crying, and it's just a test. Okay, it sucks to not be able to pass it, but this one is a tricky one. So, and we'll go into it. So, first things first, let's look at the title of the exam you're taking. It's the Property and Casualty or Fire and Casualty exam. So property and fire, number one, you got to know are interchangeable. Your homeowner's policy is a property policy. Your homeowner's policy is sometimes called a fire policy. It's the same. The test may say property loss. The test may say fire loss. It's the same. Now, the fire property section, that covers your house, your car. Under a contract, that would be you and yours. Right? So as the insured, the client purchasing the insurance, you are the first party to a contract. The insurance company is the second party to a contract. So insurance is a personal contract, which simply means it's a two-party contract between the insured, the client, which is you, and the insurer, the insurance company. All right. So keep that in mind. Now, anyone other than you two is a third party. That's the bottom on the right-hand side of the slide. Whenever you hear third party, think of liability. All right. And I always say when you think of L for liability, think L for lawsuit. So you damage someone else, you damage someone else's property, and they're going to sue you to pay for the damages. Okay. And so you and yours is the first party. You bought a policy from the insurance company, which is the second party, and they're going to protect in case you injure them and their stuff. Okay. And that's liability. All liability claims are third party claims. So keep that in mind. As far as contract law terminology, what this whole exam is about is the definition of insurance. Insurance, you may get a one-word answer, is a contract. All right, insurance is defined as which of the following? It's a contract. You might get, it's a contract to indemnify or restore someone to what they had before the loss. Or you could get the technical definition of it's a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. All right. So we're protecting against a loss. All right. Insurance is a contract of indemnity to restore you to what you had before the loss. And it's because they suffered a loss from an uncertain event. The loss must be uncertain. All right. If it's a certain loss, we won't issue a policy. I mean, if the forest fires are, or the brush fires are already heading to your house, we're not going to say you have a homeowner's policy. That's a certain loss. The fire is already on the way. And so you got to keep that in mind. The loss must be uncertain. It's a contract of indemnity. Indemnity means to restore you to what you had before the loss. So if it was a 3-bedroom, 2-bath house before the fire, it's going to be a 3-bedroom, 2-bath house after the fire when we rebuild it because that restored you to what you had before the loss. We're not going to build a 5-bedroom, 3.5-bath house with a sun deck, a pool, jacuzzi, and some skylights that you did not have before the fire because that improved your condition. That's a gain, and that's not what insurance is about. Right? Now, in order to buy a policy on someone or something, you have to have what is called insurable interest. And insurable interest is defined as having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. Now, I don't know about you folks. That's a lot to remember, but just keep the concept down. Insurable interest means in order for you to buy a policy on someone or something, if that someone or something were to suffer a loss, there's a financial effect for you, a financial interest. Okay, now you might see economic interest on the test, economic and financial interest. So what that means is you can insure your house because if your house were to burn down, it will cost you money to rebuild it. But you could not insure your neighbor's house because if your neighbor's house burns down, financially, there is no effect for you. Okay. So when you hear insurable interest, think of you got to have a financial interest, or like the test will say, an economic interest in the preservation of the life or the property that is the subject of the insurance. Okay. It's just tricky verbiage. It's very technical lingo on the exam, which throws you, because most people don't talk that way. All right. Risk, look for the word uncertainty because the risk means uncertainty, I should say. Now, there's two types of risk. We have pure risk, we have speculative risk. Pure risk is the possibility of loss only, no gain. And that's the only type of risk we can insure. Speculative risk is a possibility of loss or gain. You want to think of gambling. When you gamble, you could win money, you could lose money. All right, so it's speculative. Okay, and we don't insure that. So you could not insure the outcome of a sporting event. You cannot insure the outcome of the lottery. However, you can insure the liability at a sporting event because someone could suffer a loss. Okay, so you got to understand that concept. If you can get a gain out of insurance, we will not issue the policy. If we did issue the policy, we're going to limit what you can collect. Okay. Loss is defined as a reduction in the quantity, quality, or value of an asset. The loss doesn't have to be a great loss. A dent in your fender isn't going to bankrupt you, but it's going to cost you money to fix it. Number one. Number two, if you don't fix it, if you were to sell the car, you're going to get less than what you normally would because you have the dent in it. You see what I mean? So the loss doesn't have to be great. All right. Now, as far as types of loss, there's property loss, there's liability loss, and there's human loss. Those are your three types of losses. Don't pick financial loss. All right. The test is going to say which of the following is not an example of a type of loss. So which one does not belong? You have property, liability, financial, and human. Human kind of doesn't seem like it belongs there, but it actually does. It's the financial that doesn't belong there. Okay, because all of them cost you money. All right. So again, the test goes into those tricky worlds. So be wary of that. Peril. Peril, you're going to get all over the board on this test. Right? Peril is defined as a cause of a loss. Fire, explosion, flood, cancer, AIDS, those are common perils. Okay. They cause loss. And so either the policy is going to state what perils we cover, or perils we don't cover. And so that's what we call cause loss forms. Now, this gets a little bit tricky. So let me back this up here. Peril, down here at the bottom, is defined as a cause of a loss. Okay. And a cause of loss form is a form that lists perils. Okay. It's really tricky. It's right there in front of your face, but a lot of people, I mean, I could tell you this, and then I say, what are the cause loss forms we discuss? And people don't have a clue. It happens, because you're not used to it. So if peril is a cause of a loss, or cause of loss form is a form that lists perils. So it's a peril form. Either it's a named peril form that lists perils we cover, like basic, broad, and earthquake in commercial. All right. These are forms that actually list perils we cover. Basic form for dwelling covers fire, lightning, and internal explosion. So if it's not on that list, it's not covered. So again, these list perils we cover. And on the opposite side over here, we have an open peril form, which is also called special or all risk. We list perils we don't cover. So this is limited. Name peril policies are very limited because if it's not on the list, it's not covered. I'm sorry. If it's on a list, it's covered. It's not on a list, not covered. See, I'm confusing myself here. Open peril, we cover anything in the world you can possibly imagine, except this list of exclusions, like earthquake, flood, nuclear risk, war, wear and tear, and intentional acts. Very common perils that are not going to be covered. So if you don't see it on this list, it's covered. So let me give an example. Falling object, like a satellite. The basic form won't cover it because it only covers fire, lightning, and internal explosion. And none of them say anything about falling object. Okay. Now I look at the special form, and if I don't see falling object as an exclusion, it's covered. So this is very comprehensive coverage over here because you can only put so many exclusions on the contract, and this is not on the exclusion is covered. So you got to know the difference. These list perils we cover. This list perils we do not cover. All right, and we'll get into that as we go through the program. Hazards are conditions that would increase the likelihood of a peril occurring. There's different types of hazards. The first one is a physical hazard arising out of something structural and tangible. You can reach out and touch it. A good example would be you have badly worn tires on your car, which means it's more likely for you to get into an accident, which is a peril, which causes a loss. Okay. And so hazards are like catalysts to a peril. And there's different types. The first one was a physical hazard, something structural, tangible. We have other hazards like moral. And it ends in an L. When you see, moral ending in an L, think of lying, cheating, being dishonest. Like people buying auto insurance. When you tell them, hey, we're going to look it up, but I still got to ask you, have you had any tickets or accidents in the past 3 years? And they still lie to you. Okay. It shows, right? But I mean, they're hoping it doesn't show. But I mean, yeah, we'll still take them. We just charge them higher premium. All right. Morale ends in ale. So when you think of more ale, think of more beer. And when you drink more beer, you get careless and clumsy. The test will typically use indifferent attitude. Indifferent attitude is a risk taker, someone who goes skydiving, scuba diving, auto racing, bungee jumping, spelunking. They drive fast, they're a risk taker. And because they take risk, they're more likely to experience loss. Okay, so it's another type of hazard. All right. And in legal hazards, you hear stories of this of people that are going for more money than they're legally entitled to. It's just like 5 mile an hour traffic. It's stop and go traffic. Someone gets bumped, right? They hang up their phone, clutch the back of their neck, open the door, and fall to the ground. And now they're trying to sue you for $2 million, claiming soft tissue damage when there's not even a scuff on the fender to show that they got hit. That's a legal hazard. Okay. Now it's going to cost insurance companies money to defend the case. It'll cost insurance companies money to maybe offer a settlement. You see what I mean? And so, hopefully they negotiate down and offer a settlement, which is great, but the company had to pay money out and that they normally would not have. All right. Now that legal hazard, that money that the insurance company had to pay as a settlement to this person who's kind of making some stuff up sometimes, that's costing all of us higher premiums. So legal hazards are people that are going for more money than they're legally entitled to, and the industry is covering it with increased rates. All right? That's what that's about. All right. So on my website, my questions already have the answers highlighted because I do not want you to test yourself. All right, if you test yourself, you're going to read this question, you're going to mull it over, and let's say you picked, C, the claimant as an answer, and then you finish the test and you grade it. The next time you see this question, you're going to probably pick C, the wrong answer again. And so with my website, the answers are already highlighted. When you see this question, the insured, this B, this is the answer you want to associate with that question. And so we've discussed it. The first party to an insurance contract is the insured of the client. That means the second party to an insurance contract, is the insurance company. Sorry. I'm choking right at the beginning of the webinar. What's up with that? All right, so the second party is the insurance company. The third party is anyone who is not the insured or the insurance company. All right. Excuse me. I apologize for this. All right. In a commercial property policy, the company providing the insurance is referred to as we or us. So we, the insurance company, are going to cover you and your stuff. You and yours is the insured. Excuse me. All right. Let me back that up. Yeah. So we're getting into contract law. The test goes into that world a little bit, and we'll talk about it a little bit more in a couple slides here. But we or us, the insurance company, print up this contract, and we are going to cover you and your stuff in the event of a loss. Excuse me. We might also cover them and their stuff under a liability policy if you have that. If you did injure a third party, okay. And so, yeah, I mean, we're not going to sit with a client selling insurance and explain who the parts of a contract are typically like this and with this terminology, but it's on your test. Agents versus brokers. A lot of confusion here on the exams. If I sell life insurance and I roam around namelessly in public and start talking to people and they ask me, what do you do for a living? And I say, I sell life insurance. People will say, oh, so you're an insurance agent. And in the real world, you can call me anything. Just buy my life insurance policy. I'm a happy camper. But for the test world, that would actually be wrong because insurance agents sell property and casualty policies. They do not sell life and health. All right. It doesn't say life and health in the name. It's a life agent that sells life and disability or health insurance. An insurance agent does auto and homeowners. Now, as an agent, your job is to represent the company because you're appointed by a company or contracted by the company to sell to the public. Okay. So again, you're contracted by the company to sell their policies to the public. And when you sell the policies, they're going to pay you commission. Now, broker doesn't represent the insurance company. Broker represents a client. So a broker, you're going to charge a client a fee to find coverage that meets their needs and their budget, and you're going to place it with various insurance companies that you may have a selling agreement with. So you're not appointed by a company. You have a selling agreement that the company allows you to place business with them. Agents have an action notice of appointment by a company stating, hey, we're contracting your service to sell our policies. So between brokers and agents, agents sell. Brokers do not sell. brokers secure coverage, or brokers you might see procure coverage on behalf of a client with, but not on behalf of an insurance company. Since a broker represents a client and takes premium money from them, they need to post a $10,000 bond and they get paid by charging a fee. Um, Now, brokers cannot bind coverage. A binder is an unconditional receipt when you're writing a policy. You're taking a first, taking the application with a first premium payment, um, and a binder is you're unconditionally covered. Only agents can bind coverage because as an agent, you represent the company. The company can give you that binding authority. Broker, you represent the client. You don't represent the company, so why would we let you bind coverage if you're not even looking out for our best interest? Okay, so be wary of that. Now, insurance agent versus life agent. So this is that life and health agent. All right. Each state might be a little bit different. In California, we do have a life-only license and an accident and health license, or you can package it up and get this life agent license, which does both. Okay. But life agents sell life and/or disability. Insurance agents do not. They transact everything except life and/or disability. Okay. So when you see insurance agent, think that's the auto, homeowners, commercial person. Right. And again, you represent the company, you sell them to the client. Life agents sell life and/or disability on behalf of a company to or with it, but not on behalf of the client. So as an agent, again, your job is to sell to the public. All right. So keep that in mind. Brokers don't sell. Brokers secure coverage. All right. Now, by the way, an insurance agent is a person, and a life agent is a person. And under the, and under the California Insurance Code, or most states, a person is any legal entity, person, association, organization, partnership, business trust, corporation, or limited liability company. Any one of those is a person. All right. Now, in the property and casualty world, that you as a person, as an insurance agent, insurance broker, let me go back one slide. You might hire someone called a solicitor. Now, a solicitor has to get licensed just like you do. Now, a solicitor must be a natural person. Now, when you see natural person, that's an individual human being. So, as an agent, you can actually get incorporated. And so, as an insurance agent, you could be a corporation. But when you hire a solicitor, that solicitor must be an individual human being just like you or I. Okay. So on the test, if you see natural person, look for solicitor or vice versa. But they're only on the property and casualty side. We don't have solicitors in the life and health world. All right. All right. So which of the following best characterizes a speculative risk? Speculative risk would be gambling, and that would be you have a possibility of loss or gain. All right. Right. You could break even. Now remember, speculative risk is you could win money, you could lose money, and that's not the type of risk that we will insure. What is the type of loss exposure that would include land and the property attached to it? This is a good question. It's only liability. For property, you cannot insure land because there's no need to. I mean, if the house burns down, if you take a good look, you'll notice the land is still there, which is awesome. You didn't lose that in fire. However, someone could be visiting and slip and fall in your land, just like having a cocktail party. Someone could slip and fall in your kitchen, and they might sue you. Remember, L for liability is L for lawsuit. So although you cannot insure land with property, you can insure the liability exposure on the land, all right? Because someone could slip and fall. So again, keep it separate. Property is your stuff, liability is other people and other people's stuff. So another way of presenting that would be which of the following types of loss would result in a claim for monetary damages due to injury to another or damage to another's property? Well, if it's someone else, that's liability. All right. For this test, when you see real property, those are your structures. That's your house. That's your separate garage. That's your fence. When you see personal property, that's your contents. That's your clothes, your furniture, your pots and pans. It's easy to tell the difference between structure coverage, which is real property, and personal property or contents coverage. Flip the house upside down. Anything that falls is personal property. Anything that sticks is real property or structure. That's the best way to tell the difference between those two. Okay? So be wary of that. The possibility of financial loss resulting from the ownership of property is known as insurable interest. So we have a grandparent that owns a house, and in his will, he's going to leave it to his grandson. So the grandson runs out and buys a homeowner's policy on the house. The house burns down. Can the grandson collect? And no, they cannot collect. So nowhere did it say grandfather died. It said grandfather owns a house. In his will, he's going to leave it to the grandson. So even though the grandson has an expectant interest, they don't own the house at the time of purchasing the policy, so they don't have insurable interest, and therefore they cannot collect from the loss. Okay, so these are some of the things that the test will throw at you. And you think, well, yeah, he's going to inherit a house. He should be able to insure it. So if it burns down, at least he gets. No, he doesn't own a house. So even though he's expecting to inherit and own the house, he doesn't own it at the time of policy application, and he didn't own it at the time of the loss to collect. Okay, so be wary of those. All right. Bill and Bob have an equal ownership interest in a building worth 100,000. Bill purchases a property policy on the building for 100,000. Bob was not listed on Bill's policy, and Bob does not buy his own policy. If the building were to burn down and it is a total loss, how much would each of them collect? Now, a lot of people say, well, Bill gets 100,000, Bob gets nothing, but unfortunately, no. Bill only gets 50,000. So even though he insured it for 100,000, he only owns half the building. So he can only collect his half of the building value. Bob doesn't collect anything because he didn't buy a policy and he wasn't named on the policy. So in this scenario, Bill is overinsured and Bob is definitely underinsured. All right. Now, these are concepts for the test. In the real world, you got a whole team of people supporting you, making sure that we write the risk properly, including underwriting. Okay. So this typically doesn't happen. But again, for this exam, you want to make sure you get the concepts down and understand overinsurance, underinsurance. All right. Which type of exposure can best be defined as a condition or situation for any exposure or financial loss which is presented to an individual or family by such causes as disability, death, or sickness? And if it's family, that's personal. They're not property, right? That's family. That's personal. So the question may change. Which of the following is also known as a human loss exposure? That would still be personal. All right, think of family again. Now, if they change the question again to if it's what type of loss is a business exposed to death, retirement, resignation, or disability of a key employee, that'd be personnel loss exposure. Okay. Very common to get two, if not all three of these questions we just covered right here. Um, yeah, so make sure you study them. Where do insurers get their policy forms from? In the property and casualty world, we get them through the insurance services offices. And in the life and health world, they typically get them through the National Association of Insurance Commissioners, or NEIC. All right. All they do is create policy forms and help reach a conformity between the industry and share information with each other and the insurance companies. So as an insurance company in the property and casualty world, you get your forms from the ISO. You're going to play with it, put your name on it, maybe change some of the provisions and concepts, and then you're going to file it with the Department of Insurance for approval to charge it, to sell it and to charge a specific rate. Okay. All rates in California, I'm using California, some people might be from other states. California, we have what's called prior approval rules. All rates are filed with the California Department of Insurance and are approved before you can use them. Another way of saying that is file and use. Okay. Some states have use and file. Some states have open competition, which means the Department of Insurance doesn't regulate the rates. The insurance companies regulate themselves. That's an easy example to illustrate. Imagine you go to a street corner where there's a gas station on all four corners at that intersection. On any given day, one gas station is at least a penny cheaper than the other three, and it might rotate. Okay, and that's competition at its best. Okay, and so that's what we call open competition. All right, so the Department of Insurance doesn't really need to get involved. They may if it's excessive, inadequate, or unfairly discriminatory, but for the most part, the insurance companies do regulate themselves on the pricing. Okay. So again, in California, we use prior approval rules, or sometimes called file and use. All right. Contract versus policy. So contract is part of contract law, and we have four parts. Just think of a contract as clack, clickety clack. Okay. Consideration is an exchange of value, and for insurance, it's an act for a promise. Now, the clients do the act of filling out the application and also doing the act of paying the premium, and the insurance company is going to give a promise to pay should they suffer loss according to the terms of the contract. So that's our exchange of value. Legal purpose, well, you bought the policy to protect against a loss. All right, that's the legal purpose. That's the legal objectives of the contract and of the insured's objectives, right? Your test might flip it, and legal purpose and legal objectives, since it's designed to protect against a loss, the test may say you cannot get a gain. Well, not getting a gain is kind of the same as protecting against a loss. You see, there's two sides of that coin. So a lot of times with your online studying, you're learning one way, and then you go take the test, and they get you from the other side of the coin. So be wary of things like that. You got to have agreement. That means we have to agree to conditions in the policy. The insurance company makes the offer, typically through the agent. You have to convince people they should buy from you and your company, and your clients accept that offer. They're right. I do need that homeowner's policy. And so they fill out the application, they pay the premium in your proposal. Here's the information you requested. Can you insure me at what you put in that proposal? And then the company accepts that counteroffer because that's really a counteroffer. The agent typically through the insurance company through the agent makes the initial offer. The clients accept it, and then they submit the application, and that's kind of a counteroffer. The company accepts the counteroffer and says we can insure your house, but we're going to have to charge a little extra because apparently you had a prior loss. Do you still want it? So here comes another counteroffer back to the client, okay, that they can accept or choose not to take the coverage, right? But it doesn't matter really who makes the offer. Both parties have to agree to the conditions in the contract, okay? So you notice there's no conditions in a contract. Okay, we've met conditions when we agreed to conditions. I'm going to explain that in just a second. The last item here is you got to deal with competent parties, and that's people in their right mind. You know, if they don't seem all there, then bow out gracefully. You don't have as much as you want to sell it to anyone and everyone, especially when you're new to make money and hit your quotas. Yeah, some people you just realize it's not worth the time and energy. They're more of a headache, and after a while, you can bow out. Okay. So they got to be mentally competent, cannot be intoxicated or under the influence because their judgment impaired. All right, cannot be a minor. Right. Remember, you can buy insurance when you're 16 because you can get a driver's license, a learner's permit at 15 and a half, and you can start driving at 16. But in order to drive, you got to have insurance. So be wary that you can buy insurance when you're 16. You just can't sell it till you're 18. Okay. So competent party means they got to be legal age. Let me explain that. Legal age, mentally competent, not under the influence. All right. And a weird one that pops up is they cannot be a public enemy. Now that one's more on the life and health test. Public enemy is someone who's armed and dangerous and wanted by the law, and you're going to sell them a life insurance policy. So the police shoot and kill them as they apprehend them, and that person's beneficiaries made some money from the policy you sold them. Yeah, that we're not going to have that happen. So that was a weird one that popped up on the life and health test, but it might pop up here. This is kind of the code and ethics section, which is on both exams, the life and health and the property and casualty exam. Okay. Now, parts of a policy, we have DICE. The declaration page, the first page of the policy, sometimes called the deck page or deck sheet. It tells you who the insurance company is, who is the insured, summarizes the coverages, and also states the premium. The insuring agreement, or sometimes you'll see insuring clause, is actually part of that declaration page. It just tells you the type or kind of policy you bought. Right? So the clause it describes that an individual purchased a personal auto policy would be which of the following, and that would be the insuring clause. Okay. The conditions clause or conditions agreement spells out the duties and rights of both parties. It really spells out the obligations of what the client needs to do to collect from a loss. So when you see conditions, the clause or conditions agreement, look for it spells out the obligations of each party. If a client suffers a loss, they're obligated to notify the insurance company. They're obligated to provide proof of loss, right? And the company's obligated to investigate, settle, and pay the claim if it's a legitimate claim. And so that's all spelled out in the conditions agreement. Exclusions are real simple. It just tells you what the policy will not cover. Right? Certain exclusions, catastrophic losses you want to keep in mind, nuclear risk, right? Earthquake, volcanic activity, flood, common exclusions, right? Definitions page. All your policies do have a definitions page so people know who you and yours is versus we or us. They know what bodily injury is. They know what property damage is. They know what inherent defect is or inherent vice, which we'll get into a little bit later. but there's a definitions page in the contract. And endorsements sometimes are also listed. Endorsements, think of additional charge for additional features and benefits. If for those of you that are in the life and health world, that would be called a rider, additional charge for additional features and benefits. In the property and casualty world, we call them an endorsement. It's kind of like getting an options package on a brand new car. You bought the brand new car, and for a slight additional charge, we can get the tinted windows, the sunroof, maybe the undercarriage coating if you're going in the snow. Again, for a slight additional charge. That's typically what that is. Not in all cases, but quite a few. All right. So know the difference between contract, right, parts of a contract, and parts of a policy. So remember, conditions is part of a policy, but conditions is not part of a contract. There's no conditions element here, so be wary of that. It's actually in the agreement element. Remember, we agreed to conditions stated in the contract, right? But it's not an element by itself. What I'm trying to say is your test will say all of the following are elements necessary for the formation of a valid contract, except, and it's a lot of times it's going to be conditions. It doesn't belong here. Okay. And for new people taking a test, you think, well, in order to have a contract, we got to meet conditions, right? Well, yeah, but it's within the agreement element. It's not its own separate element. Okay. Personal auto coverage. Now, I'm using California. So again, I may have some people from other states on the webinar here, but in California, we have split limits, and the minimum liability to register a car in California is 15, 30, and 5. The first two numbers cover the people. What this means is we will pay a maximum of up to $15,000 for any one person in an auto accident, and a maximum of $30,000 for all people in the accident that you caused. Remember, this is liability, so it doesn't cover you and your passengers in your car. This covers the people in the other car that you hit, or maybe even a pedestrian. We're going to pay up to $15,000 per person, but $30,000 max for everyone that were injured because of that accident, that one occurrence. Now, the third number, this 5, stands for 5,000, and that's for, let's say, the car that you hit, the property damage. So the first two numbers cover the people. The third number covers the property, like a car. Maybe you lost control and drove through someone's living room. We'll pay up to $5,000 to rebuild their house because you took out the living room. Yeah, I don't think that's enough, but this is the minimum in California to register your vehicle. So since liability covers the people in the other car, medical covers you and passengers in your car. All right. I'm using 2,000. You can buy 1,000. You can buy whatever, whatever you want. I've seen some companies up to $100,000 medical coverage. Now, medical covers, like I said, you and your passengers in your car that are injured in the accident you caused. You see, if the other person hit you, their insurance covers your medical bills. But if you get into an accident, you injure other people, that's coverage A, covering them in their car, and then medical covers you and the passengers in your car. All right. Some people want to cut their rates, and so they sign off on it, acknowledging that they don't want this coverage, which is fine. I'd recommend you do keep some, but that's, above somewhere else. Okay, so Part C is uninsured motorist. Now, this is the liability coverage it pays you because someone else without insurance hits you, and it's their fault and they don't have insurance. So this pays you. If we're going to pay someone else $15,000 if we injure them, well, we should at least get $15,000 for ourselves if someone hits us and doesn't have insurance. Remember, with these, you can always buy higher limits. Just give you a heads up. But this is only covering the people. That's why there's only two numbers. Uninsured motorists, and this underinsured motorists you might see on the test also, is you get hit by someone that has insurance, they just don't have enough to cover all of your medical bills. And so again, this coverage that you set could fill that void. Right? So if I have 100, 300 up here, my uninsured motorist should also be 100, 300. Because if I'm going to pay someone 100,000 if I injure them, I should get 100,000 for myself if someone without insurance injures me. Okay. If you don't want the coverage or you want lower uninsured motorist limits than your liability limits, your clients need to sign off on it. Okay. I have them sign off on the uninsured motorist. I have them sign off on the medical if they're choosing not to take it. So if something happens, they're going to say, that, hey, you never offered that coverage. And I show them a form that, yeah, I did. You signed off you didn't want it. Okay. Because at the time of the accident, if they're injured, you're going to be the focal point of their anger and aggression, and they're going to not remember what you told them in that conversation when you sold them the policy. So always document it. Uninsured motorist property damage. So this covers your car because you got hit by someone who doesn't have insurance. Okay. And if you only have these liability coverages A, B, and C, which are all liability coverages, the maximum we're going to pay to fix your car is $3,500. Okay. Very common for the exam to see this particular number, uninsured motorist property damage. So California has lower financial responsibility limits than most other states. So if Randy, a California personal auto policy insured, carrying minimum limits of coverage, has an accident in a state that requires higher limits, his policy automatically provides those higher limits while he's visiting another state with no extra charge. How cool is that? Okay, so let's say, Randy, California resident, drinks too much Red Bull. He wakes up out of a haze in Alaska, gets into an auto accident in Alaska, and I believe their liability limits are 50, 100, and 25. But he only bought 15, 30, and 5 here in California. As long as it's just a visit to Alaska, he's automatically provided with those higher limits, no extra charge. Now, that's just a visit. If Randy actually relocates to Alaska, well, then he typically needs to register the car and get the proper coverage. Okay. Um, okay. So automobile limits of liability are expressed as 25, 50, and 10 mean what? We just covered this. 25,000 is bodily injury for each person. 50,000 bodily injury for all people in that accident. And then the third number, 10,000, is for property damage. Right? To their car. Remember, it's their car. Liabilities to the other people. Okay. So be aware of that. You got to know what these numbers mean. They may change the numbers, but what the numbers mean doesn't. So make sure you get that down. That's the liability section. So now we covered the other people and you and your family and your car and your friends. Let's talk about your car. That's covers D, physical damage. And there's two parts of this. We have collision and other than collision. So collision is your fault, where you damage your car because something you did. And so this covers the cost to fix your car because of an accident you caused. Okay. And then other than collision covers damage to your car when it wasn't your fault. So I would say collision is your fault. You hit something and damage your car. Other than collision, you damage your car, but it's not your fault. Like a tree in a storm falls on your car. That's an other than collision claim. See, in the real world, we call it comprehensive. The test goes and uses other than collision. All right. So if you drove into a tree, that's a collision claim because you caused it. It's your fault. Usually higher deductible. Your rates are going to go up because it's your fault. Other than collision, like I said, a hailstorm damages your car. That's an other than collision claim because the hail hit you. You didn't drive into the hail. Usually lower deductible, and your rates don't go up because it was not your fault. All right. Now, if you lock your keys in the car and you break the window to get your keys out, that's not going to be covered because that's an intentional act. Wear and tear and intentional acts are not going to be covered. Wear and tear also includes mechanical breakdown. Okay, it's where your car breaks down on the road. That's not covered under your auto policy. Okay, so be wary of that. Physical damage is Part D, covers anything bolted, welded, nailed, attached to the car, including tools associated with vehicle repair. That would be the spare tire, the tire iron. But if you're in the construction business and you have tools, that's not what we're talking about. If someone breaks your window, steals your cell phone, that's not covered by this. That's covered by your personal property under your homeowner's policy. Okay, so be wary of that. Anything bolted, welded, nailed, attached to the vehicle would be covered here. Okay. By the way, if someone steals your car, that's an other than collision claim. Okay, if someone steals your car. Now, if there is damage to your car because of collision or other than collision, well, then you might need to rent a car. That's transportation expenses, optional coverage. Your car's in a shop, we can pay you $20 a day, usually after a 24-hour wait. But if someone steals your car, you have to wait 48 hours before we pay you $20 a day for rent a car. The $20 a day is common for the California exam. You can always buy a higher limits in the real world. Okay. And for the test, if someone steals your car, like I said, there's a 2-day wait before we give you $20 a day for a rental car. If your car is in an accident, you can't drive it. Hopefully, you have towing and roadside assistance, which covers, according to the test, labor conducted at the scene of a breakdown or labor conducted at the place of disablement. It's just a tow truck taking you to the nearest repair shop, and that's basically it for the exam. Okay. So damage done by an earthquake to an insured auto is covered by the personal auto policy if you have other than collision. So earthquake and flood is actually covered under your auto policy if you have other than collision coverage. Okay. Hmm. And under a personal auto policy, which of the following is not a collision loss? And that's when you hit an animal. If you hit an animal, we always say the animal hit you. You don't want to swerve to miss a deer and then roll your car because that's a collision claim. Remember, higher deductible, your rates go up. So we always say the animal hit you. It's other than collision, lower deductible, and your rates don't go up. Okay. But unfortunately, instinctively, a lot of people do swerve, and accidents are caused because of that. So, okay. But for the test, we always say the animal hit you. Might be a deer, might be a cow, might be a dog on your test. All right. All right. So, rating factors for liability under Proposition 103, which is the Unruh Act. Very common to see Prop 103. Very rare to see Unruh Act, but I had to put it up here because I did get some feedback. People saw it. And so the number one or most important factor in rating someone for liability coverage is your driving safety record. Okay. And that could be a question all by itself. What is the most important factor in rating someone for liability coverage? Well, your driving safety record. The second item would be how many miles you drive annually. 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 Okay. How many miles you drive annually. Do not pick number of miles you drive to employment because that would be a wrong answer. Okay. The third thing is number of years of driving experience, right? The longer you've been driving, the more experience you have, and so your rates come down. To get a good driver discount in California, you got to have been driving at least 3 years. No tickets or accidents in the past 3 years. And if you do qualify for the good driver discount, you get at least 20% off the normal rate. Okay. And so these are the factors that if you qualify, will kind of help qualify for a good driver discount. The fourth thing is any other factors that have a substantial relationship to the risk. A lot of that's location. People live in downtown. I'm in San Francisco Bay Area. So if you live in San Francisco or Oakland, where there's more cars on the road, historically there's also more losses because of that. So you're going to pay higher premium than someone who lives in the outskirts out in the sticks where there's fewer cars and fewer accidents. So rates vary by geographic location. So for liability, your rates are based on how you drive. Okay. So I'm going to jump around over to tort law. Under tort law, a person can face a claim for legal liability on the basis of all of the following except breach of contract. So tort is defined as a legal wrong other than a crime or a breach of contract. So tort law does not include criminal law, and tort law does not include contract law. All right. The biggest area of tort would be negligence. We do have intentional torts. We have unintentional torts, right? So that's B and C. Absolute liability is different from strict liability. Absolute liability is where the public demands that people that engage in it be held responsible. A good example of absolute liability would be workers' compensation. If you are an employer, you hire employees, it is required by law that you have a workers' compensation policy in place to look out for your employees. So if they're injured, you're held liable for their medical bills. Okay. Yeah, so that's a form of absolute liability. When you hear strict liability, or you see that on your test, look for manufacturer. All right. So let's say we have a toy company, they manufacture a toy and they sell it through Toys R Us, and then you buy it from Toys R Us. Well, that toy malfunctions and stabs your kid in the leg. You're not going to sue Toys R Us. They're just a distribution channel. You're going to go directly over to the manufacturer and sue them for the defective toy that caused your child's injury. Okay. So strict liability means basically we're going to hold a manufacturer strictly liable for all losses with their defective product, regardless of the distribution chain. Okay. And these are parts of tort law. Okay. But contract law and criminal law, that's not tort law. Now, so we talked about rating for liability. Let's talk about rating for physical damage. Well, physical damage, all I want to know is what are you driving? Okay, so rating you for liability is how you drive, which is your driving experience, but rating for physical damage is what you drive. All I need to know is year, make, and model, because if you damage your car, how easy is it to find parts? You see? So it's based on what you drive. Keep them separate. All right. There's absolutely no coverage in Mexico, down here at the bottom. If you do get that question, how far does your personal auto policy provide coverage for you in Mexico? It doesn't. Okay. Now, some of you think, well, wait a minute. If you get the endorsement, it can cover you, right? That's not what the question said. Okay. under a personal auto policy or an unendorsed personal auto policy or an ISO personal auto policy, it doesn't cover you in Mexico at all. Now, there's a different question, which we'll get to, is if you buy the Mexico coverage endorsement, then it could cover you. Okay. And at the bottom here, intentional accident wear and tear is not covered. Okay. Wear and tear is also mechanical breakdown. That's not covered. All right. All right. Let's jump to cancellations. Different types of cancellations. All right. So prorate is, let's say you paid for the whole year. You paid advance for your insurance, and for some reason someone canceled 9 months into the contract. Well, the company is going to keep the first 9 months premium because they covered you. All right, they've earned it, and so they're going to return the last 3 months premium back to you because they're not covering you, so they haven't earned it. So that's a prorate cancellation. We keep the earned, return the unused or unearned. Now, short rate is whichever party cancels a policy, the company's going to keep the earned because again, we covered you up until the date of cancellation. They're going to return the unearned premium minus like a fee, like an overhead expense. What this is, when you see short rate, think of you're getting shortchanged for leaving an insurance company. All right. Now on the exam, it doesn't matter who does the cancellation. Get the concept down. All right. What I mean by that is it'll say the insurance company cancels the policy. They return the unearned premium minus a fee for overhead expenses. This is an example of that's a short rate cancellation. Now, in the real world, that typically doesn't happen. Why would an insurance company cancel your policy and then penalize you with a fee? You see what I mean? But for the test world, remember, they just want to make sure you understand the concept. It doesn't matter who does the canceling. Okay. So when you see short rate, think of you're getting shortchanged by a fee because you're leaving the company. All right, either an overhead expense or an admin charge. Flat rate is we void the contract and refund all the premium. We pretend like that policy never existed. A lot of times you'll see this listed as rescission. Okay, so a client pays annual premium on an auto policy. They suffer loss. It's deemed fraudulent. The insurance company is going to cancel the policy, refund all the premium. This is an example of what? Rescission or flat rate cancellation. Okay. Because in a possible fraudulent situation, I don't think the insurance company wants any liability. So here you go. Here's your money back. Thank you very much. Have a nice life. Okay, that's a flat rate cancellation. All right. Now let's go back to liability versus physical damage. For liability coverages, if you have liability only and you're replacing a vehicle with another vehicle and you only want liability, you don't have to do anything. You're automatically covered to the end of the policy period. Because remember, for liability, we're not covering the car. So you had a car, you traded in for, you have one car. So if you had one car before, you traded in, you have one car now. But we're not even covering the car. So you don't have to tell the insurance company because the risk hasn't changed. It's still, we're just covering you, the driver behind the wheel of the car. So does it matter that you're driving a Volkswagen Bug or a Cadillac Escalade? It's still you behind the car for liability. So the rate doesn't change. But the bottom here, if you have one car for liability coverage and then you add another car for liability coverage only, now you have to tell us because instead of one exposure of one car, you have two cars. That's two exposures. And if the risk changes, we, the insurance company, need to understand that and be notified. Okay. So that's for liability only. Now, for physical damage, if you had liability coverage only and you get another car or you replace the car and you want physical damage, if you didn't have physical damage, which is that collision other than collision beforehand, you have 4 days to let us know and add it on. Okay, because you didn't have that coverage. But if you already have physical damage coverage on a car and you replace it or buy another one, since you already have physical damage, you have more time to let us know. We'll give you 14 days. Okay. Now, this example here I'm using in California. Other states may be slightly different. Okay. So I'm still researching information from other states and starting to put some programs together for other states. But here in California, this is the rule we go by. In the real world, most companies, as long as you have your policies with that company, they give you up to 30 days to notify the insurance company add another car. But for the test world, no. You have to follow these guidelines. Okay. So sample test questions. All right. Dave has an automobile insured by a personal auto policy. He trades in his car and he buys a new private passenger auto as a replacement vehicle. If he does not notify the insurance company, the liability coverage for his replacement vehicle will apply automatically, and that's until the end of the policy period. Okay, remember, he's replacing a car, but he's not getting physical damage coverage. So he had one car, he replaced it for one car, the risk hasn't changed. Okay, now remember, if it's physical damage, he's got to tell the insurance company within either 4 or 14 days. Common endorsements for personal auto policies. We have a miscellaneous type vehicle endorsement. There's really no such thing as a motorcycle policy. It's an auto policy with an endorsement that says this policy is covering a motorcycle. And that particular endorsement is called that miscellaneous type vehicle endorsement. May not be a motorcycle, could be a dune buggy, a golf cart, an RV, or once in a while on tests you'll see ATV, all-terrain vehicle. Okay, but this can cover the vehicle. All right. Named non-owned auto coverage. This is for people that live in the city that don't own cars. They borrow their friends' cars or they rent cars for long trips. This only gives you liability coverage because you can't cover a car that you don't own. All right. So always remember, named non-owned auto coverage is for people that don't own a car. They borrow their friends' cars or they rent cars for long trips. And again, it's only liability coverages. When I say liability coverages, that's liability, medical, and the uninsured motorist coverage. All right. Extended non-owned auto coverage. Before we get into this, let me back it up. Let's say you have insurance for your car. You borrow your neighbor's car to run a quick errand, and you get into an accident. Okay. The key point you got to keep in mind is insurance follows the vehicle. So if you borrow your neighbor's car and you get into an accident, your neighbor's insurance will be primary for that accident because it's your neighbor's car. Yours will be secondary if your neighbor doesn't have adequate coverage. All right. Now, likewise, if the neighbor borrows your car and gets into an accident, your insurance will be primary. Your neighbor's insurance will be excess because it was your car. So remember that insurance follows the vehicle. And that's for occasional use. If you work for a company, you have a personal auto policy covering your car. You work for a company, they give you a company car to use for regular use. Your personal auto policy actually specifically excludes vehicles that are furnished for your regular use. Okay, that means if you have a personal auto policy, you have a car, you have personal auto policy, you get a company car to use, and you get into an accident in the company car, and they sue the company because it's a company car, but they also sue you. Hopefully, your company has good coverage because if the lawsuit exceeds the coverage your company got for you, the rest comes out of your pocket because your policy specifically excludes vehicles that are furnished for your regular use, and that would be the company car, so it doesn't cover you with that. And so you can lift that exclusion by buying the extended non-owned auto coverage. So basically read it like we're extending coverage to a vehicle that you don't own, but you use regularly. Okay. The limited Mexico coverage endorsement. Remember, your personal auto policy does not cover you in Mexico at all. That's a territory limit. But if you bought the limited Mexico coverage endorsement, it can cover you for up to 25 miles into Mexico. That's 25 miles into Mexico from the U.S. border, not the Mexico border, and for no more than 10 days. All right, so it is limited, just like it says. All right, remember that it's 25 miles from the U.S. border, not the Mexican border, and for no more than 10 days. Okay. All right, so which of the following best describes a tortfeasor? And it's someone who commits a tort or someone who is negligent. All right. So yeah, the at-fault person in a negligent situation. What's the difference between a personal auto policy and an ISO personal auto policy? There is no difference. Okay, didn't I say all the companies get their policy forms from the ISO and then file it with the Department of Insurance for approval? And so a personal auto policy versus an ISO personal auto policy is the same thing. And this is confusing. I mean, in your studying and your training, you learn under personal auto policy this, under personal auto policy that, under a PAP this, under a PAP that. Then you go take the test and it says under an ISO PAP or under an ISO personal auto policy, and now you're thinking that's something totally different. It's the same thing. In fact, when you see that, just don't even read the ISO. A personal auto policy is the same as a personal auto policy. Okay, don't get confused by that. Another way of confusing is throwing this word in front of that also. Under an unendorsed personal auto policy. Unendorsed means there's no endorsements. So you just bought a regular personal auto policy, which is the same as an ISO PAP, which is the same as a PAP. So there's no difference between these three right here. Sorry, it's just they put ISO or unendorsed in front of it to kind of throw you off, thinking it's a whole nother program out there, and there isn't. They'll do this for your homeowners section also under an ISO HO3 or unendorsed HO5. Just don't even read it because it means nothing. An HO3 is the same as an ISO HO3. An unendorsed HO5 is the same as an HO5. All right, don't get confused by that. The named insured is someone who's named on the policy, like Jack and Jill own the car, so they're both named. I said Jack and Jill, that means the first named insured is Jack. That means the first named insured controls it. So even though Jack and Jill are both named on the policy, the first named insured can cancel the policy, is responsible for paying the premium. The first named insured can request changes to the policy. The first named insured can actually transfer the policy to someone else with insurance company's written permission. So even though both of them are named, the first named insured controls and makes decisions on the policy. And that you got to keep that in mind. Now, an insured is anyone covered by the policy but not named. That means you lend your car to your neighbor and they get into an accident. Well, it's your car, so it'll still be covered. They're still an insured. They're just not named on the policy. And remember, that's occasional use. If they use your vehicle regularly, they should be added to the policy and rated. Okay? All right. If an insurer pays an insured $25,000 in lost wages, $45,000 for physician's visits and hospital costs, and $15,000 for physical therapy treatments, and later finds out that the claim was fraudulent, the insured may be fined as much as, and it's $170,000. Now, where you get the numbers is submission of a fraudulent claim. Number one is a felony. Number two, up to 5 years in prison. Number three, $150,000 fine, $150,000 fine, or double the value of the fraud, whichever is a larger number. So if you add these three numbers up, back. All right, sorry about that. All right, so if you add these three numbers up, 25 plus 45 plus 15, it equals 85,000, but you have to double it, and that's 170,000. Now, 170,000 is a larger number than 150,000, so that's what would be the fine. Remember, $150,000 or double the value of the fraud, whichever is the larger number. Okay. A standard fire policy. Now, this one's kind of funny. We don't sell this anymore. This is for California. It's called a standard fire policy because it is the only policy where the wording is standardized by law. That means if you do get a hold of the California Insurance Code book, you can look it up and see this whole policy's verbiage laid out in the California Insurance Code book. Okay. Oops, I keep bumping this thing. Apologize for that. All right. So a standard fire policy covers three perils: fire, lightning, and removal. Removal is more of a situation than a peril. Okay. And it's only on this policy. All right. So if you don't see anything on this list of fire, lightning, and removal, then it wouldn't be covered because this is a named peril policy. Now, if you want, for a slight additional charge, you can add extended coverages, sometimes called EC, and it's a package of 7 additional perils. The easier way to remember it is the awards: windstorm, hail, aircraft riots, vehicle explosion, and smoke. All right. So it's a package of 7 additional perils that you can add to the program. Then if you buy the extended coverages, then you can buy the vandalism and malicious mischief. Now, the vandalism coverage has a 60-day limit. What that means is if the property is left vacant or unoccupied for more than 60 days, we, the insurance company, will not cover vandalism losses. See, if no one's watching your house for 2 months, it kind of becomes a target for vandals, and the insurance company doesn't want to cover that because that's an increase in risk. Okay, so now, fire, this is hostile fire. Friendly fire, like a fire in your fireplace, it's not covered because you don't need firefighters to come out and put the fire in your fireplace out. But if a spark shoots out of the fire in your fireplace, catches your drapes on fire, and starts going through your house, that's a hostile fire, and that is actually covered by your insurance. Fire that's intentionally set is arson, and that's not covered because intentional acts are not covered. This is you lighting your own house on fire, that will not be covered. Okay? If someone else lights your house on fire, that actually would be covered because that's a loss to you. All right, so keep that in mind. Another thing about this is a lot of times there is a mortgagee clause to where, let's say, you let your insurance drop and you light your house on fire. You couldn't collect. Well, number one, there's no insurance, and if you did file a claim, it'd be fraudulent claim. However, if you have a mortgagee, a lien holder, the lender, they can actually pay the missing premium and still collect for the loss. All right, just so you know. Right? Lightning is natural bolts of lightning, not electrical arcing from your outlets. Right? And removal, although it's listed as a peril here, it's more of a situation. Your house is on fire. The first thing you do is get you and your family out, and then you call 911, and then you start taking some of your property, removing it from the burning building, and putting it out in the front driveway to protect it from further loss without endangering yourself. During removal, you have all risk coverage. So even though a standard fire policy is a named peril policy, during removal, because you're trying to protect your property, we're going to give you all risk coverage. Okay. All right. So what perils are insured against under the additional coverages property removed of a homeowner's policy? And that's all perils. So this is the test way of saying during a period of removal, what type of coverage do you have? And I just said all risk or all perils, right? Open perils. This is how the test words at. So let me go back. Removal, during a period of removal, you're taking your stuff out of the burning building, you have all risk coverage. Okay. And this is how it shows up on the test. So it's very tricky on this exam. It's very easy not to pass, unfortunately, if you haven't studied the right material. Um, because, I mean, it's almost Greek to you. Like, what are they even asking here? And some of your questions are like that. All right. So you still want to answer it. All right? Don't use a skip or flag or mark button. Just go ahead and answer it. Just write the question number down on your scratch sheet of paper, and at the end of the test, go back and take a look at it. All right. And by the way, at the end of the test, only go back and take a look at the ones that you wrote down in your scratch paper. If you finish early, that's okay. It's okay to be the first one done, but don't say, I don't want to be the first one done. Let me just go through it one more time. No, only go back to the ones that you wrote on your scratch paper. Because if you go through the whole test all over again, you're going to change your right answers to wrong answers. And you don't want to do that. Stick with your initial instinct. It sounded familiar, so go with it. Okay? Don't talk yourself out of it. You may get the differences. What's the difference between a standard fire policy and a dwelling policy basic form or a DP1? It won't say it directly like this. It'll say a standard fire policy provides coverage for which of the following? You need to know it's fire, lightning, removal. But you'll have fire, lightning, internal explosion as one of your other answers. You may get a question that says under a dwelling policy DP1 or basic form, it provides coverage for which of the following? You need to know that it's fire, lightning, and internal explosion. But again, fire, lightning, removal will be one of your other answers. And so make sure you know the difference between the perils covered by a standard fire policy and the perils that are covered by dwelling policy basic form. Okay. All right. So now we're going to jump into a homeowner's policy. And to me, homeowners is going to that restaurant and getting the combo plate, the burrito, fries, and a drink. All right. Or I said burger. Burger. All right. So burger, would that be the property coverage, right? Fries, that'd be the theft, and the drink, that'd be liability. Okay. And so when you go to that restaurant, this is a combo plate: burger, fries, and a drink, all packaged up. All right. So that burger has four parts here. We have the dwelling. We have other structures. All right. Dwelling is coverage A. Coverage B is other structures. Coverage C is personal property, and coverage D is loss of use. All right. So dwelling, coverage A covers the main dwelling. Anything bolted, welded, nailed, attached to your house, that's coverage A. All right. Coverage B is other structures. So the separate garage, the pool house, the fence, that would be other structures on the premises, separate from the main dwelling, maybe just a utility line connecting the house from the separate garage. All right. And coverage C is personal property, that's contents coverage. Remember, flip the house upside down, anything that falls would be coverage C. Coverage D is loss of use. And so if your house burns down, where are you going to stay? So this covers the cost to put you up at a hotel till they rebuild your house so you can move back in. That's all part of the property section. Theft is included in all our policies. We'll get into some sublimits in a minute. And Section 2 liability, which is coverage E, personal liability, and coverage F, which is medical payments to others. All right, since it's liability, you and your family can't collect from this. This is for your guests. So if you or your family slip in your own house, you can't file a claim against your homeowner's policy. Because number one, you cannot sue yourself for all the stuff that you already own. However, if you have a cocktail party, one of your friends slips and falls in your house, they can sue you because they don't own your stuff yet. Okay, that is the liability section covering others. Notice all the coverages are the same on all of our contracts here. So theft and liability the same on all of our homeowners policies. So the difference is the property section. So let's dive into that. You're fresh out of high school, fresh out of college, you move out of the house, you get your own place, you're probably going to rent. All right. So you buy an HO4, which is a renter's policy. All right. It's kind of funny on the test. There's no such thing as a renter's policy. It's a homeowner's policy that's designed for a renter. All right. And this homeowner's policy is an HO4, all right, broad form. There's no coverage for structures because as a renter, you don't own the building and you don't own the separate garage. You're just covering your belongings in someone else's apartment or home. Okay. But it does give you loss of use because if that apartment that you're living in burns down, you're going to need some money to live. And that's what the loss of use coverage is. All right. And again, theft and liability is the same, built in. HO6. Let's say we move from a renting a place to we buy a condo somewhere. Now I don't care if the condo is in downtown the city area or in a farmland community. A condo is a condo is a condo, and that's an HO6. So we're going to change the coverages because you do need coverage A. If you buy a condo, you actually own the kitchen cabinets and fixtures in the bathtub. And so we need some structures coverage for that. But if you own a condo, there's really no other structure. So there's really no coverage B. The car part is usually covered by the condominium association program. Okay. Now, if you do own a separate storage unit or a separate garage, we can add coverage B. But in general, it does not come with the contract. All right. You still need to cover your personal belongings. That's coverage C. And if your condo burns down, you need a place to stay. That's coverage D, loss of use. All right. So then we save up enough money, we buy a house. Now, when you buy a house, you have three choices. You have HO2, HO3, or HO5. Okay, so three different choices on a homeowner's policy. So do you want good, which is HO2? HO3 is better, but HO5 is the best. Okay, so let me explain. All of them cover dwelling, other structures, personal property, and loss of use. The difference between these is what type of coverage do you have on the dwellings versus what type of coverage you have on your personal property. So HO2, that's HO1 is a basic form, HO2 is broad form. And broad form is a name peril form. So under HO2, you have broad form coverage on the buildings, and you have broad form coverage on your belongings. Now, HO3, we're going to take a step further. We're going to give you all risk coverage on the buildings. So you have better coverage than broad form coverage on the buildings, but you still have broad form coverage on your contents. So let me back this up. You have so-so coverage on the buildings, so-so coverage on your stuff on an HO2. You got great coverage on the structures and so-so coverage on your stuff on an HO3. But HO5, I says, is best because you have great coverage on the buildings, and now you have great coverage on your stuff in the buildings too. Okay, and so it does provide better coverage on an HO5. Okay, and so you got to know the differences between these, right? What's the difference between coverage on an HO3 versus an HO5? And you're thinking, well, the personal property coverage is different, but the test will say, well, that's actually coverage C. Okay. The test will say under Section 2 of a homeowner's policy, it provides liability for all the following except. Okay. Well, this Section 2 personal liability covers you and your family members while you are anywhere in the world except two places. Number one, when you're driving your car, because that's your auto liability. Number two, it's not going to cover you at work. Now, those of you that think workers' compensation does, that'd be a wrong answer also, by the way. Section 2 is liability. Liability doesn't cover you. It covers other people. So the Section 2 homeowners won't cover you at work. Workers' comp doesn't cover liability at work. Workers' comp covers you at work. But your commercial general liability, your employer setup covers you, the employee, injuring the customer. That customer is a third party. Okay, so be wary of that. Now, although I say Section 2 of a homeowner's policy doesn't cover you when you're driving a car, that's way too easy for the language on this test. Your test will say Section 2, liability of a homeowner's policy provides coverage for all of the following except. And it doesn't say cover driving your car. It says you're driving your registered licensed vehicle on 10 acres of undeveloped land. Well, if you're driving your registered licensed vehicle, it means you're driving your car. The fact that it's on 10 acres of undeveloped land is useless knowledge. Your Section 2 of your homeowner's policy doesn't cover you when you're driving your car. So there's a little bit of interpretation on some of these questions, right? Just so you know. Some additional coverages under homeowners. If you borrow your friend's camera, travel to Europe, and you drop it, we'll pay up to $500 to replace their broken camera. Right? Loss assessment. If you're part of a condominium association or a townhome or a homeowners association, and they do impose a loss assessment, your policy will pay $1,000 per occurrence. In California, I have to emphasize that because I may have some people from other states. In California, okay, a mandatory endorsement on a homeowner's policy is workers' compensation. Okay, so it is a mandatory endorsement in California. Okay, just so you know. Some of the other additional information, if you are a condo owner, HO4 or HO6 may be used. Right? Look for HO6, that's key. If you own a mobile home, you can get the mobile home endorsement. The MH200 can be added to an HO2 or HO3, but you cannot get an HO5 for a mobile home. The mobile home must at least 10 feet by the mobile home must be at least 10 feet by 40 feet and worth at least $4,000 to be covered. Right? And some rare questions. An HO8 is a modified HO1, and it's used for antique homes, older homes. Homes that are built back in before the 1920s, sometimes 1920s. The key point here on this HO8 is it pays on an actual cash value basis. See, if an antique home burns down, we can rebuild it to look just like it did before the fire, but it's no longer an antique, and so we just give you actual cash value. All right. All right. So differences between a homeowner's policy on the property side and a dwelling policy. So a homeowner's has four parts, coverage A, B, C, and D, which is the dwelling, other structures, personal property, and loss of use. I use DOPL, DOPL. A standard fire policy of dwelling, the property side actually has five parts. The first three are exactly the same, dwelling, other structures, personal property. Instead of calling it loss of use under dwelling, it's split up to rental income and additional living expenses, which loss of use is actually broken down into additional living and rental income. Why they did this, I don't know. So a standard fire policy, a dwelling policy, the property has five parts, use DOPRA, and then the homeowners has four property parts, which is DOPL. Okay. Even though they're pretty much exactly the same, because rental income D over here is the same as, loss of use part 2. Additional living expenses is loss of use part 1. So it's the same. They just broke it down differently for some apparent reason. Okay. All right. So we had a homeowner's policy. All right. Now let's step it up and let's become a landlord. And that's how you want to understand a dwelling policy. All right. And so as a landlord, you pick which form you want. You can get the basic form, which remember, it's named peril. Broad covers more perils, and specials all risk or open peril. And so the difference, DP1 is good, DP2 is better, DP3 is the best. All right, so DP1 covers fire, lightning, internal explosion. Remember, it's a named peril form, so there's limited coverage. Where a broad form is also named peril, it just covers more than the basic form. And then special is open peril all risk. We cover anything you can think of except for a list of exclusions, right? And so, again, if you're a landlord, basic is good, broad form is better, but special would be the best, okay? Now, all it is the structure coverage. So this is going back to that restaurant and just getting a burger, okay? So did you want the, hamburger with cheese, or did you want the gourmet burger? Okay, that's all it is. DP1 is a hamburger, DP2 is a cheeseburger, DP3 would be the gourmet burger with the, onions, all that stuff. Okay, now, did you want fries and a drink on the side? Because that's over here, liability and theft are optional. Okay. So homeowners is going to that restaurant and getting the combo where the burger, fries, and a drink all come packaged up, and it's also cheaper. A dwelling policy is eating off the a la carte menu. Pick a burger, and did you want fries and a drink? Will be an additional charge. We can add it on. Okay, and that's what this is. Okay, so but the coverage is pretty similar. Let's jump to the math question. A lot of people hate math. Number one, you do need to know this equation. It could be a test question all by itself. What is the coinsurance equation? And it's the amount of insurance you did have divided by the amount of insurance you should have. Now, you take that fraction and you multiply it by the loss. That's going to tell you how much the insurance company will pay on your claim minus any applicable deductible that the test question will give you. Okay? So let's put this into play. So here's a question. We have an apartment house worth 500,000. The owner insures it for 300,000. The policy has an 80% coinsurance clause, and there's a $200,000 loss. The insurer will pay, and if you're not sure, real simple, let's just plug in the formula. The amount of insurance they did have is 300,000 because that's what they bought. The amount of insurance they should have, well, that's 400,000. Since a company says there's an 80% coinsurance, you should carry at least 80% to the value of the building. So don't put 500,000. If you put 300,000 divided by 500,000, you're going to get a wrong answer because you don't need to carry 100%. Right? You only need to carry 80% of the value of the building. So 80% of 500 is 400. So 3/4 times the loss of 200,000 equals the 150,000, and that's the answer you want. Okay. So that's how you need to understand that. Right. A lot of people they make the mistake. They put 300,000. That's what you did have divided by 500,000. 3/5 times the 200,000 loss, and the answers don't look like it's related to anything. I came up with a whole different answer. So maybe the test question's written wrong. No, it's right. The bottom number of that fraction, remember, the should is 80% of the value of the building. Okay. So, all right. Valuation clause. That means if you suffer a loss, how will your policy pay out on the claim? Is a replacement cost, which is what we typically insure structures at, is what does it cost to replace that house brand new? All right, if it's a 3-bedroom, 2-bath house, we're going to rebuild it just like it was, rebuild a 3-bedroom, 2-bath house. That's what replacement cost is. Actual cash value is how we typically cover your stuff in your house. That'd be your clothes, your furniture, your pots and pans. So what is it? Actual cash value is defined by replacement cost, which is what does it cost to replace it brand new, minus the given depreciation that the test will give you. Okay. And so they might throw in the original price for something is let's say 9,000 and it's destroyed by a fire, and to replace it now costs 11,000. Given 6,000 in depreciation, how much would the policy pay? The original price throw out. You can't get it at that price because it costs 11,000 to replace it today. So even though they throw in useless information like the original price of a furniture is 9,000, you can't get it at that price. So what does it cost today? 11,000 minus the 6,000 depreciation. 5,000 is going to be your answer. Okay. Market value is if you were to sell the property just before the loss, what would you have gotten for it? Okay, so look for the answer. Sold, right? Stated value or valued policy. Think of an antique car, right? Where we pay the actual cash value of the loss up to the stated value. Now, antique cars, they don't make those parts anymore. And so in a partial loss, you could get a full payout, right? So remember, for stated value policy, we pay actual cash value for the loss up to the stated value in the contract. Okay. Fair claims practice. So if a client suffers a loss, these are the steps that they need to take. Part of the conditions clause. Number one, they have to notify the insurance company immediately that they suffered a loss. Now, when I say immediately, sometimes the test says immediately in writing. Okay. The key word is immediately. Right? They won't have one immediate writing. It's just going to be look for immediate. Okay. When you notify the insurance company you suffered a loss, number one, they're going to acknowledge you suffered a loss. Number two, they're going to begin their investigation on the claim. Number three, send you some claim forms or a notepad for you to write down what you lost, because you need to submit proof of loss within 60 days of the loss. Okay, not 60 days of the not within 60 days of getting notice. I'm sorry, not 60 days of them acknowledging it. 60 days from the time of the loss. Okay. And then the insurance company should pay the claim immediately unless they notify you that it's still under investigation for some reason. But they do have to give full disclosure on that. Okay. This is how a claim should be handled. If a claim is not handled this way, it could be a sign of unfair claims practice. Okay. Attempting to settle a claim for less than what a normal person would feel they'd be entitled to. Um, um, Telling you to resubmit proof of loss. Resubmit means they acknowledge they already got it. You see what I mean? Um, and directly advising a claimant not to obtain the services of an attorney. So we're not going to pay your claim. You cannot get a premium refund, and don't run out and get an attorney. No, that would be unfair claims practice. Okay. Now they might flip the switch, which the following is okay. It's okay to advise them to go talk to an attorney, okay, or to go deal with an attorney, but don't say don't get an attorney. Okay. All right. If there is a loss and there's a discrepancy between you and the insurance company, okay, depending on the type of loss, it will depend on how we settle it. So for liability, we go through arbitration. Um, the client chooses an arbitrator, the insurance company chooses an arbitrator. These two arbitrators pick a third arbitrator. You plead their case to them, and that third arbitrator makes a decision. It's kind of like Judge Judy, huh? They come in, they plead their case, Judge Judy makes a decision, and it's final. So it is binding arbitration. Now that's for liability losses. For property, it goes through an appraisal condition. So you pick an appraiser, the insurance company picks an appraiser, these two appraisers pick an umpire that hears both sides and makes an ultimate decision. Okay. So know the difference between arbitration and appraisal. Okay. Typically going to get one or the other. All right. Going back to tort law, X is in an accident with Y. X suffers $5,000 of damage, but it is determined that Y is 60% responsible for the accident. How much would X receive under contributory negligence rules? And when you see contributory negligence, neither party gets anything. See, if you contribute in any way, shape, or form, you cannot collect. So even if you only contributed like 2% towards a loss, since you contributed toward the loss, you're not entitled to any compensation. All right. Now you might get this one, or you might get this one. Same question, except now it's comparative negligence. And under comparative negligence, this is where we actually share in the claim. And you'll hear stories. Two people back out of a parking lot at the same time at the mall, and they bump each other. Right? One was 51% at fault, one's 49% at fault, and their insurance company's sharing the claim. That's comparative negligence, right? And so read the questions carefully. Under contributory negligence, the answer is zero. But under comparative negligence, they share. So make sure you get the right dollar amount on that one. Okay. And I've had people get between 3 to 5 questions just on these two topics. Right. Other personal lines coverages: excess liability is additional liability over one line. I'm in the San Francisco Bay Area, so there's a lot of people live in the city that don't own cars. Um, but they do want additional liability to cover them and their actions anywhere in the world, and so they buy excess liability. And excess liability, as you can see, clearly only covers additional liability over one line of coverage. So when you hear umbrella, personal umbrella, think of higher limits, broader coverage. Now, in order to get an umbrella policy, you got to have personal liability, typically like one associated with a home, and auto liability to get an umbrella. But you can also extend coverage if you have a boat with adequate liability. You can also have it covered by the umbrella. And if you have a liability exposure that's not covered by an underlying policy, it can still be covered by the umbrella, but you're going to have to pay what's called a self-insured retention, which is basically a deductible for losses that are not covered by an underlying policy, but can still be covered by the umbrella. Okay. All right. We'll get to that in just a sec. Some other lines: personal property floater versus personal article floater. I'm using jewelry here, although it doesn't state that. If someone breaks in your house and steals all your jewelry, your homeowner's policy is going to basically pay you a maximum $1,500 for theft of your jewelry. Okay, well, for some people that's enough. If it's not enough, would you like additional coverage? Well, the first step in getting additional coverage is getting that personal property floater. and this is going to cover your jewelry at higher limits of coverage on an unscheduled basis. Now, when I say unscheduled, means I don't need a list of your jewelry at the time of application. However, at the time of the loss, I need to show you need to provide proof that you own that jewelry. Okay. Now, it basically just gives you more coverage than the normal homeowner's policy provides, but not much. Maybe $7,500 to $10,000 max. Okay, so if you have jewelry that's worth that limit, let's say 10,000, then you get a personal article floater, and that's where you start scheduling your jewelry. Okay, that means I need to know it's a 4 carat ring on a platinum setting. I need to know the cut, the clarity, the quality of the stone because that's scheduled means I need a list with appraised values. Okay, so I mean you stick with your homeowners because you don't have a lot of jewelry. You go with the unscheduled because you have a little more than homeowners, but nothing expensive, and then you get scheduled because you do have expensive jewelry. Right? And it's not just jewelry. I'm just using that as an example. It could be for your firearms, your gun collection, could be for silverware, because your policy or your homeowner's policy has a sublimit of $2,500 for theft of firearms, $2,500 for theft of securities. I'm sorry, theft of silverware. And so if you want higher limits, then you get these floaters. Okay, and you can pretty much throw a floater on all your collectible items, even stamp and coin collections. But cash, normal cash that you interact with on a daily basis, the maximum your homeowner's policy will pay for theft of cash or any type of loss to cash is $200. Because anyone can say they had $80,000 in their mattress and it burned up in the fire. Okay, and so you can get a personal article floater, personal property on pretty much most of your collectible items, but you cannot get it for cash or money. $200 is the limit no matter what. Okay. So what is a self-insured retention under an umbrella policy? And it's that deductible that covers that you'd have to pay because you have a liability exposure that's not covered by a base policy but can still be covered by the umbrella. Okay, so let me go back to that one. That's this. It's basically a deductible. Since umbrella is an excess policy, you got to have a primary. If there's no primary, you need to pay something for an excess to kick in. That's what that's about. Okay. All right. So let's say you have a boat. If it's a small watercraft, one of the easiest ways to cover it is add it to your homeowner's policy as a watercraft endorsement. The catch to this is if you add a boat to your homeowner's policy, the boat's going to mimic your homeowner's policy. That means if you slip and fall in your house, you can't file a claim against your homeowner's policy. You should have health insurance. That means if you add the boat to the homeowner's policy, it's not going to cover if you and your family members slip and fall in your own boat because it only covers liability and medical for other people like your guests. Now, in order for that watercraft to be covered on your homeowner's policy as a watercraft endorsement, it has to be scheduled. The insurance company needs to know that it's a 20-foot bass fishing boat with a 22 horsepower engine. All right, so it needs to be scheduled. So the better coverage is to get a boat owner's policy. And a boat owner's policy is similar in design to an auto policy. Because an auto policy, you have liability in case you hit someone, you have medical for you and your passengers in your car, and you have physical damage for the car. All right. Well, so if a boat owner policy is the same way, well, we need liability in case we hit other people, medical for you and your guests in your boat, and we have physical damage for the boat. All right. Very common test question. A boat owner's policy is similar in design to which of the following? It's an auto policy. Now, these are smaller watercraft. If you got an ocean-going vessel, well, now we go to yacht coverage. And instead of saying liability and medical, we're going to call it protection and indemnity, or sometimes called P&I. Okay, so that covers liability and medical. To cover the ship itself is now we're going to change the terminology to hull coverage, which covers the ship, the engine, the motor, including the gasoline. All right, and so these first three are personal use of watercraft. That means even if you're having an office party on your yacht, as long as you're not charging a fee, that can be covered by your personal auto policy, or I'm sorry, your personal boat policy, your yacht policy, as long as you don't charge a fee. Now, using your boat as a water taxi, charging a fee, that's a business use. That's not covered here. Okay, just like your auto policy, if you're charging passengers a fee as a taxi or livery conveyance, that's not covered. Livery conveyance, by the way, think of a hotel shuttle from the airport. That's what they are. So don't get confused by that. They transport people to and from the hotel. That's how you need to understand that. Okay. But that's business use, so it can't be covered by your personal auto policy. You got to get the proper coverage for that. So this is personal use of your boat or yacht. Now, if you're in the business of an ocean-going vessel, that's the ocean marine coverage. So think of a cargo ship or a cruise line where you have protection and indemnity because you need liability and medical for the crew, what you're transporting, what you hit with the ship, right? Um, your passengers on your ship, and also workers' comp for the captain and crew is kind of built in here. Physical damage covers the ship itself. And since you're in the business of transporting stuff, you need cargo coverage to cover what you're shipping. And you need freight coverage just in case you lost the cargo. People paid you to have things sent. And so freight would be like reimbursing your postage when you send a package that gets lost in the mail. Now, if you have insurance, the insurance covers the cost to replace the package. Freight covers the cost to reimburse your stamp because you had to pay to have that package shipped. Okay, so cargo covers what you're shipping. Freight reimburses the shipping charges. That's how you need to know that. Now, on land, we have territorial limits, but on water, at the bottom here, we have navigational limits. Of our webinar tonight. Okay, if you have not registered, you want to access the sample test questions, go ahead, go to lgdstudy.com. There's PayPal links. Just click the one next to the course you want. If you do have questions, reach out to me. You can also email me. Okay. At this point in time, I'm going to open it up for questions.